Hi there, and thank you for joining me for this video entitled Personal Income Tax for Entrepreneurs, brought to you by Constructum Online Learning. This video forms part of the Business Life Stages series, and in particular, the first installment, namely the concept stage. Most people who start a business will come from some type of employment background. As an employee, you'll be used to a situation where your employer payroll department would have calculated your personal income tax liability on your behalf based on your remuneration package. The payroll department withheld tax from your salary and paid these monies over to the receiver of revenue on your behalf. At the end of the tax year, the 28th of February, your payroll department then provided you with an IRP5 reflecting your total remuneration for the year and the total amount of tax already paid over to the receiver. You would then have to complete your tax return. Most people use the very effective online tax portal, e-filing, and that would be that. Not much else is there then for you to do. The situation is very different when you join the world of entrepreneurship. As an entrepreneur, you are responsible for calculating your income tax liabilities and for paying over the tax to the receiver of revenue. If you fail to meet these obligations in a timely manner, the receiver can institute financial penalties and, in the worst case, even criminal charges. So it's best you understand your income tax obligations. In this video, I will cover the following: what is personal income tax, how to calculate your income tax liability, and how to meet your obligations to the receiver of revenue as an entrepreneur, a taxpayer running their own business. Personal income tax is levied on any income an individual receives and may include the following: remuneration. That could be a salary, commissions, incentives, and for most business people, it would be something like director's remuneration. On rental income from any asset, like for instance an investment property that you rent out, the net rental income is income and is liable for personal income tax. Then there's interest on any money market investment or savings account. Dividends from owning an interest in a company. Later on in the series, I will talk about dividends withholding tax, but for now, just understand that dividends are also a form of income. Then there's capital gains from the disposal of an appreciating asset and is also now included in the calculation for personal income tax. Then any other form of income from either local sources or from abroad. So any worldwide income or capital gains. Your tax liability is calculated over the tax year, starting on the 1st of March and ending on the 28th of February. South Africa has a progressive tax dispensation for individuals. That means that the more income you earn, the higher tax rate applies to you. See the table included in the slide. From the table, you can see that a person earning, say, 180,000 Rand for the year or 15,000 Rand per month will be liable for a tax rate at 18%. So a total tax liability of 32,400 Rand or 18% would apply. But let's look at a person earning 300,000 Rand per annum or 25,000 Rand. 300,000 Rand is the second line, right? 226,001 to 353,100. This person will be liable for tax of 40,680 Rand plus 26% of the taxable income above 226,000. So a total tax liability of 59,920 or 20%. So do you see that a person earning 300,000 would be at an effective tax rate of 20%, where a person earning 180,000 would be at an effective tax rate of 18%. That's why we say it's a progressive tax dispensation. The more you earn, the more you pay. To understand your personal income tax liability, you need to understand what is meant by taxable income. So start with gross income. Add up all of your income from all of the different sources that you might have. So remuneration, for a business owner, this might include a salary or director's remuneration. Interest income, that could be from a savings account or an investment account. Dividends, local dividends are exempt, but dividends from foreign sources are taxable. And rental income from an investment property or some other asset. The total amount of all your income is called your gross income. Then, from gross income, deduct your exempt income. Primarily, that would include local dividends and the first 23,800 Rand of interest earned if you are under the age of 65. Gross income minus exempt income gets you income. Then you deduct from that any deductions. Now, the receiver of revenue allows for a variety of deductions, including expenses in the production of income and contributions to certain retirement funds, but there are limits that apply. Then add capital gains from the disposal of an appreciating asset. For the purpose of this video, I'm going to assume that a person at the very early stages of the entrepreneurial journey will not have any appreciating assets that they can dispose, which will result in a capital gain. Add the taxable portion of any business allowances received by you, the taxpayer. So this might include the use of a company-owned vehicle, a cell phone allowance, or any other sort of financial benefit that you receive. And then you get to taxable income. So to recap, taxable income is gross income minus exempt income. Gives us income. Minus deductions, plus the taxable portion of any capital gain, plus any allowance that you receive from the business, and there you've got your taxable income. Now that you know your taxable income, you can apply the tax table as shown earlier to calculate your income tax liability. Then deduct from this tax liability the relevant rebates as reflected in the table below. Most people listening to this presentation will be below the age of 65, so the primary rebate applies. Meeting your tax liabilities. As a business owner, your income is variable and certainly sporadic in the first couple of years of trading. Very few business owners can draw a fixed monthly salary from their startup businesses. This makes it difficult to calculate what your total annual tax liability might be at the beginning of the year. Consequently, the receiver of revenue requires business owners to register for provisional tax. Provisional tax is not a separate tax to income tax, but rather a way of managing your tax liability. A provisional taxpayer must calculate their tax liability twice a year, at the end of August and the end of February, and pay the required tax. So provisional tax is calculated in two periods, namely the first period ending the 31st of August and the second period ending the 28th of February. But taxpayers may add a third voluntary period if needed. Let's look at an example of how provisional tax might be calculated. The first period runs from March to August. So let's say our business owner Joe earns a monthly taxable income as reflected in the table below. We keep an annual running total. So by the time we get to August, Joe has earned 110,000 Rand for the first 6 months of the year. The estimated taxable income then for the full year is 110,000 times 2, because we've got 6 months for the first period and 6 months for the second period. So now we estimate what would be the total tax for the year as per the tax table, and that comes to 39,600. But we've only been in 6 months of the 12 months of the year, so we divide that by 2, and that then gets us to 19,800. Plus, we know that Joe is below the age of 65, so we can deduct the primary rebate, but we divide the primary rebate by 2 to get a pro rata amount for the first 6 months. So the pro rata amount is 8,213 Rand. So deducting that pro rata rebate from the 19,800, we get to a total tax liability for the first period of 11,588 Rand. So now we look at the second period running from September to February and Joe's monthly taxable income reflected in the table. Again, we've got an annual running total, and we see that by the end of February, Joe has earned 233,000 Rand for the year, slightly more than what we originally estimated. So his total taxable income for the year would amount to 233,000 Rand. We then apply the tax tables and we see that Joe, by applying the tax tables, would be liable for 42,500 Rands worth of income. But Joe has already paid 11,588 Rand in the first 6 months period. Also, we have to again deduct the pro rata primary rebate of 8,230. That then gets us to a total tax liability for the second period of 22,700. Add that tax liability for the first period to the second period and we get to a total tax liability of 34,288 Rand. If you fail to calculate your tax liability correctly, you may find yourself in trouble with the taxman at the end of the tax year. So it's best to keep track of your income tax obligations and to calculate your tax liability on an ongoing basis. Understanding income tax becomes very important as an entrepreneur. But there is more. Since you have established a business as a separate legal entity, you need to also understand about corporate tax, the corporate tax applicable to your business's income. As director of a company, you are responsible to ensure that the business meets its tax liabilities. Look out for the next video wherein I will address the tax liability of your business. Thank you for listening. I hope you learned something today. I strongly recommend that you talk to an accountant and tax practitioner for advice on how to understand and manage your income tax liabilities and obligations. If you found value from this video, please consider subscribing and click the notifications bell so that you are informed of any new videos that I load. Good luck on your entrepreneurial journey.